So pretend like you're going out for a fundraise. You got an idea for a new company you're really, really excited about, and you've put together a ton of different resources that you're going to be using to tell people about your company. You're putting together your pitch deck. You've got this vision in your head. Maybe you've got your co-founders, and you're excited to go out into the world and try to raise money for your new company. Then the first time that you pitch an investor, they get really, really excited about the idea. They're bought in and they want to dig in more, and they ask you for a 5-year financial model. They want to understand the financial picture, what that's going to look like for your idea into the future. Now, you may immediately ask yourself, why does this person want to see a financial model? Everything is theoretical right now. This is just an idea. Maybe it's two people that are just kicking around something that they have a lot of passion about, but it's not really real yet. So it doesn't really make sense for us to actually try to put numbers together and commit to anything like revenue or any type of tangible milestones. And you may be scratching your head wondering, why does this person care? Why is this a worthwhile exercise? Why is this investor asking me for projections on an idea? Well, today I want to talk to you about the 4 reasons why investors actually care about this. These are the things that are going through an investor's head whenever they ask founders for a financial model, because I promise you, investors don't like just giving founders busy work. There is a method to their madness, and the best investors have a rationale for how they like to evaluate startups, and a financial model is a part of some of their investment criteria. So I'm going to go through the 4 reasons why investors actually care about your financial model. So the first reason that investors care about your financial model is that they want to make sure that you understand the future of your business. They want to make sure that you have thought through, as the founder, what the future of this company looks like. So they want to get an understanding of the strategy of the company. How are you going to be growing? It may not be real, right? These are things that are going to change a lot, especially whenever you're really, really early. Maybe you haven't generated any revenue yet. This strategy is highly subject to change, but that doesn't make it a meaningless exercise. The investors want to make sure that you have gone through and you have thought out what the future of the company could potentially look like. So these could be things like, what are you going to be spending money on theoretically? How are you theoretically going to be growing the company? Is it going to be based off of paid ads? Is it going to be based off of influencers? What are the things that are in your head that you need to do in order to grow this company? They just want to make sure that you have thought through the business and that you have a good understanding of your own business. So in that way, it's almost like a check mark of, does this founder actually understand and have realistic expectations about their business? The second reason that investors care about your financial model is that they want to understand how your KPIs need to change and what your KPIs need to be in order for them to hit their goals. So if you're a SaaS business, what does your pricing look like today, or what is it going to look like right out of the gate whenever you start generating revenue? And how does that grow over time? Is that realistic? Is that something that they feel like could actually happen? What is your theoretical churn rate coming out of the gate? How is that going to change over time? Do you have realistic expectations? What are your theoretical unit economics going to look like? They want to understand, does your business model support your strategy, right? So if you have a very low lifetime value and you're relying on, let's say, outbound sales or something like that, it's a signal to them that this is probably not something that's going to work for them, because it's probably not a viable business strategy given the business model that you have. So they essentially want to understand what the future of the business theoretically can look like and see if they can believe what the future of that company is going to look like. The third reason that investors care about your financial model is that they need to understand whether or not the outcome of your business is going to match their investment thesis, right? So what I mean by that is, if this is, let's say, a larger fund that focuses mainly on moonshots, they want companies that can be $1 billion or more than $1 billion in enterprise value, yet in your financial model, you're projecting that the valuation of your company might only hit $20 or $30 million based off of your revenue projections. It may signal a mismatch in expectations of what they want to achieve versus what you're shooting for. So depending on the investor, some investors have the mindset of, this investment needs to return the fund. It has to be an absolute moonshot. It has to be a massive, massive, massive company. Other investors are more focused on cash flow and they want something that's more sustainable. They want something, or perhaps they're more comfortable with something that could just be 20, 30, $50 million company. They're on board with more sustainable growth. But at the end of the day, it really just depends on that investor. So it's very, very important that the investor goes through the exercise to understand what is in the founder's head and what is in their investment thesis, and make sure that those two things mesh together very, very well. And the fourth reason that investors care about your financial model is that they want to understand what the future financings of the company could look like. So if you plan on hiring a lot of people, burning a lot of cash, spending a lot of money in an effort to achieve a very, very high rate of growth, that probably means that you're going to be raising significantly more capital. Some investors might be really excited about this because that is an opportunity for them to continue to invest into your company and in some cases potentially increase their ownership percentage. Other investors may not like the idea of having to carve off a ton of follow-on capital to continuously not get diluted. So they're going to want to understand what they're getting into in terms of their participation in future financing rounds. A financial model is going to give them some visibility into that just by showing them how you plan on spending your money, what your growth rate is going to look like, what your theoretical cash balance is going to look like, and so on and so forth. So hopefully this is valuable. If you want a little bit more on fundraising strategy, especially if you're a company that doesn't have any revenue yet, I've shot an entire video on how to raise capital if you're a startup that hasn't generated any revenue. We're going to put a link in the description below. But as always, thanks for watching. Hopefully you got something out of this video. Thanks so much for watching the video. If you enjoyed the content, please don't forget to like and subscribe and turn on bell notifications to get notified every time that we bring out a new video. And if you love our content, you want more, click on the link at the bottom of the video to join our mailing list, where you're going to get content around finance, fundraising, and all things startup in your inbox every week. Thanks so much, y'all.